Hello and welcome to Talking Global Infrastructure, GIA's podcast, where we look at all aspects of the infrastructure investment landscape. In this episode, we're going to take a look at the infrastructure debt market. Now, many of our listeners will know this area very well, but I'm guessing a few, like me, perhaps are less familiar. So to help guide us through the world of infrastructure debt investing, I'm joined by two experts, Stefan Futschik, Head of Private Debt at Prime Capital, and Valter Lourenço, Managing Director for Private Fixed Income for Sun Life Capital Management. So let's start with the basics, if we may. Tell us about the companies you represent, whose money is it you are investing, and what is the source of that capital, and how much capital are you deploying, and where in the market?
First of all, thanks, John, for the invite. Let me introduce Prime Capital a bit to give you an idea what we are doing in the infrastructure debt market. So Prime Capital is an alternative investment management company. We were set up in 2006, so we just had our 20th anniversary. And we have assets under management of more than 13 billion. And we are just investing into the alternatives market. And one of our main asset classes is infrastructure debt, where we are deploying money since roughly a decade. What are we doing? We invest in the broad infrastructure debt market. So vast majority will go into the energy market, but we are also active in other parts of the market like social infrastructure, utilities, transportation, and so on. From an investment perspective, we are focused on the lower mid-market, and we are focused on continental Europe. I'm heading the team, the investment management and asset management team, where we are covering these assets, and we invest for institutional investors only. So our investors are insurance companies, pension funds, CTAs, family offices, and so on.
And Volta?
Jon, first of all, thank you for having me on this podcast. So I'm Valter Lourenço, and I'm a portfolio manager for the SLC's private fixed income platform. What is SLC? SLC is a group of global asset managers offering a diverse range of traditional as well as alternative asset classes across the various affiliates that we own at the SLC platform, and that includes BGO, Crescent Capital, Infrared, as well as the SLC fixed income platform that I'm presenting here right now. So look, you asked about how much do we deploy, like speaking from a pure AUM perspective, and this is the whole platform. We are looking at a current AUM of $309 billion, so this is US dollars. From a client base, we are looking at pension funds, insurance companies, family offices, foundations, and now I'm going to be speaking just for the infra debt strategy, or I should say IG infra debt strategy. The team is looking for investments in US, Canada. We have a very strong footprint in several countries in Europe, so actively involved in Europe as well. And we do have certain pockets in the Asian market as well, but it's not our main strategy necessarily. Regarding, what are the sectors? Way back, I would say mostly social and transportation, but it has evolved quite a bit over recent years and decades. So we are looking at power generation, power connectivity, power transmission assets. Again, social, of course, transportation, but we also have now the digital space that became more predominantly represented in recent years within the infrastructure space. Again, thank you for having me, and happy to jump on IG infra debt from my perspective.
Very good. So let's just sort of start by taking a look at the model for debt investment, just sort of briefly, because I'm interested to sort of find the comparison with the way that your thinking is structured by comparison with equity investing model, which the majority of GIA's members are focused on. So, do you follow similar principles in terms of, the kind of risk return categories, core plus, value add, or how do you kind of think about the relative kind of return and risk sort of balance, and how does that inform your strategies?
Yeah, no, thanks for the question. I'll kick it off. And again, I'm going to be speaking it from an IG infra debt strategy. And before I go into this whole labeling, core plus, value add, which you hear a lot on the equity side in particular, let me just step back what it actually means from a IG infra debt perspective, and meaning from a board perspective as well as from as an asset class for our investor base. From a borrowing perspective, you look at the capital stack, and they use a lot of hands usually. So you have the equity angle, you have the mezzanine, high yield type capital, which I think Stefan will talk about it. And then basically what you also have is the senior end of the capital stack. This is what our strategy represents. So what is our main focus? Our main focus is downside protection. So when you look at the return capacity of this asset class, it is naturally limited by the coupon that you are setting. So it's not like on the equity side where there's significant upside. No. Once you invest, once you set the coupon, this is your return matrix. So downside protection is extremely important for us. How do we achieve that? It's basically looking at cash flow predictability, cash flow certainty. So when the investment team looks at opportunities, they have highly qualified consultants involved, being top-notch lawyers that are very focused on infra debt in particular. The investment team is highly trained to review contracts, not just on the revenue side, but also OPEX, so every contract that touches a project. So you want to make sure that from a downside perspective, you are highly protected. So the focus is there, cash flow certainty, predictability, hopefully non-complex O&M arrangements. So if you put this a little bit into the equity angle that you mentioned about core plus, and etc., you probably can see that as a core type investment, but again, it's slightly different from our perspective. The one thing that it also offers for borrowers is predictability when it comes to our debt instrument in their project. And why? Very often these instruments come with a fixed rate coupon, so we set the coupon up front, so there is no potential interest rate volatility. In particular, when you look at the last few years, euro mid swap going from negative to plus 3% within, during COVID, within a year, 1.5 years. So you don't face that risk from a borrowing perspective, which is quite appealing for borrowers. In addition to that, it's tenor or duration. So usually when you look at this debt instrument, it offers tenors anywhere between 5 to 40 years potentially. The longer you go, I think it's pretty obvious that the stronger you get, you have to get comfortable on predictability when it comes to the underlying business, of course. But this is something that is highly appealing for investors because you are basically fixing a core component of your capital stack with very predictable, debt service payments going forward. Speaking on the investor side, and I'm going to keep it nice and short as well. So I did mention insurance companies, pension funds, foundations. The demand for this asset class vary, and it really depends. When you look at life insurance companies, for example, they traditionally have a very strong demand for long duration assets. So they're very happy to invest in 20, 25, 30-year debt instruments. But they're also, investors that are seeing infrastructure debt as a strong portfolio diversifier in their portfolio. You have your public equity, you have private equity, you may have your high yield component there, public fixed income, but then by adding a bit of private IG infra debt, what it offers is diversification, increased diversification, but also that excess yield that generally IG infra debt offers in comparison to public infra debt instruments out there.
Maybe if I can add to that, and I think Valter was already talking about a lot of these typical infrastructure debt topics. In general, it's absolutely true. It's at its core, debt is built on the idea that you are lending into either corporate, infrastructure corporate, or a kind of project. That's why it's called sometimes project finance. And these projects have to deliver reliable services to service a loan. And that means that we are heavily related to stable, contracted, or sometimes also regulated cash flows. That's important, I think, to the industry. Things like offtake agreements, partially contracted revenues, sometimes in the past more and more, today a bit less, pure availability-based assets, so assets which are there and pay a stable income either directly from the government or indirectly. And more and more also some merchant components which we see in the market. But all of them provide some essential services. I think that's important to understand, and these revenues have to work also under stressed environments, because our returns, and that's valid for Valter on the more focused on senior level, and for us more on the holdco unitranche level, interest payments are key. So we are not an equity investor, we are debt investors. So cash flow stability is key for us, and not the growth of the project or the company finally. So that investment works totally different from equity, because our goal is not to capture the upside. We are looking into the downside protection. That's the key attribute for us. So stable, predictable income while protecting capital. That's what we try to create in our positions. So we are not talking about core plus value add, things like that. That's not so important for us. For us, it's, as Valter said, where do we sit in the capital structure? How do we mitigate downside protection? How do we create sufficient buffer in our structures, so sufficient equity? And more cash flow stability means you are able to provide more debt to the project in general. So while equity investors talk about strategies like core asset, in that we express more the same ideas through risk layers in the capital structure, and the strengths and resilience of the project in terms of different market scenarios and environments. I think that's for us key. What are we searching for that? As I said, we are usually investing in unitranche situations. We are going into holdco situations where senior financing is provided by a different party. It can be a bank, it can be an insurance group, or an asset manager like Valter. That we are in a situation where we provide complementary capital to the sponsor, but both of us search for reliable cash flows, because when we are talking about infrastructure, we have to talk about low default rates, high recovery rates. That's what we are searching in the market. And again, to talk about the investors, insurance groups are usually a bit more searching for long-term debt. Pensions, family office CTAs, they are a bit more yield-driven. I think we also have to keep in mind that we have in Europe a different base rate environment compared to the US. And when we started infrastructure debt roughly 10 years ago, in Europe we had a zero base rate. We had sometimes minus 0.5 base rate. So it was a kind of substitute for government bonds for some investors. In the current environment, it's totally different. So they need yield. They also like duration. And in Europe, at least for insurance groups, it's important to invest in infrastructure, not just for duration and yield, but also because the solvency capital is privileged in terms of infrastructure.
Well, thanks both for setting out that landscape for us. Very helpful. I mean, we've seen huge growth in the infrastructure asset class over the last 10 years for sure. And I think I'm right in saying that the debt part of that market has also, has seen equivalent growth. So, what is driving that? Why have we seen more capital coming in to the debt investment side of the infrastructure asset class? What's been behind that, would you say?
I would kick off. I think there are different arguments. First of all, is not just 10 years ago, maybe more 30 years ago, we had a binary market. Infrastructure was purely contracted or purely covered by cash flows coming from municipalities, from the government. So that's why a lot of these deals were in the transport sector. So if you're going back to the 1990s, the vast majority, maybe 100% of the market was in transport, motorways, tunnels, and so on. And the market has shifted since then a bit. More and more sectors became part of the infrastructure market. More and more merchant situations or partially merchant situations came to the market. If you are looking back with regard to renewable energy, for example, at the beginning, the offtake was something where you were able to mitigate the price risk, but there was still volume risk. So the market moved since then a bit. When we are talking about infrastructure today, we're talking about battery storage, energy transition. We are talking about parts like transport, but a lot of markets are part of the broad infrastructure allocation. And parts are a bit more in the gray area between, let's say, real estate and infrastructure, if you're talking about data centers, for example, or social infrastructure. The other trend is that the capital structure has shifted since then. At the beginning, it was project finance plus equity. And since 10 years, there is another layer in the middle, holdco debt, which was not part of the market 15 years ago. So we have developed a new market with huge growth, and there are different reasons for that. Over the last 10 years, one is when we are talking about infrastructure, we are talking about mega trends, decarbonization, energy independency, digitalization, and these trends are part of our current discussion without the economy, without the communities, and everybody is expecting modern infrastructure today. So we see trends, and these trends were also driven by governments. If you are talking about ESG, so ESG was something which was pushed in some economies. But we see different situation today compared to 2 to 3 years ago. So there's a lot of development in the market. We'll come back to that in a moment, probably. Back and forth, but what means infrastructure? Also, what we have done in the last years, it was always stable with downside protection. Our investments done in the last 2 years, pretty stable in the market. And that's what investors love: stability over a long period.
Yeah, maybe to add from my perspective. So when I look at infrastructure, we want to make sure it's critical. And again, downside protection, we talked about it, cash flow stability, talked about it, but it has to be critical in nature as well. So when you look at, let me step back. I think Stefan just mentioned transportation in the 90s, social transportation, social infrastructure was part of it as well. Why? Because, again, criticality, transportation is quite important. Social, hospitals are, of course, very important. And, when you build these up, they're usually under public-private partnerships where there might be cash flows coming from the authorities. So it's great from the infra perspective. That's what you want to see. So what you have seen in the last 10 years, and let's take COVID, for example, connectivity doesn't just mean driving from A to B, but also means communication. So the digital connectivity, and I'm going to use that as an example to address your question, John. Digital connectivity has become extremely important. Imagine COVID without the digital connectivity. That we are doing these virtual calls these days, I don't know, they were not as common 10 or 15 years ago. Things have changed. Connectivity, connecting to colleagues, you don't necessarily need to go into the office, which is great, you should, but you do have now an alternative to potentially work from home or work wherever you are and be connected to people. So that critical element is definitely a key ingredient when it comes to infrastructure. So what has happened on top of that, let's take a very specific segment, cell towers. Cell towers used to sit, they still do to some extent, they used to sit at a telco's balance sheet. So it's a nice mix, huge balance sheet. You provided corporate type credit to the telco. You don't really assign value to a cell tower. Why would you? You are looking at the telecommunication services, that the cell towers are there. It's great, yes, it's needed, but you don't assign real value to that. You just assume it's there. So by actually spinning off those cell tower portfolios, as an example, you're actually creating a different pool of assets that you can provide leverage against it. And in the case of cell towers, why is it extremely favorable? It's because, cell towers, very non-complex, like we have seen those cell towers all over the place. It's non-complex for an CapEx. It's upfront, a little bit of maintenance as it goes. But the key ingredient is very often that it benefits from long-term revenue contracts with those telcos. So you take that asset, you isolate it from any type of market dynamics, and now you're purely focusing on the revenue contract or the revenue framework that supports that asset. You actually can provide very decent leverage against that. Something that a sponsor, a company may not have benefit from it before. So we have seen that push in trying to identify criticality where cash flows are predictable, and by isolating it, you actually can create investable platform for the borrower and eventually, of course, for investor base as well.
So I'm interested to explore how the volatile kind of geopolitical world that we are currently living in, how that plays out in terms of the debt investment kind of process. I mean, I get it from the equity side. We spend a lot of our time working with and talking to our members about how the tailwinds and the headwinds that are facing the sector create opportunity, but they also create risk to be managed and drive diversified portfolios. And I mean, how do you think about these kind of things from the debt side of things? To what extent do these does this kind of volatile world that we're faced with right now impact either your current investments or you're thinking about future investments?
Yeah, John, no, thank you for the question. When you look at the last 5 to 6 years, yeah, certainly it has been quite volatile, not just geopolitically, but you had a pandemic in between, you have interest rates going up and down. So how do we look at it from a IG infra debt perspective? So we try, and let's put it in two buckets. There are certain projects that are cyclical agnostic, I would say. And those are, think about social infrastructure where, hospitals are needed. It doesn't really depend on the economical state of the province, the state, or the Fed, right? So from that perspective, you have assets that are extremely cyclical agnostic. You have assets that are certainly influenced by that. Like think about, as an example, toll roads or the whole transportation segment. During COVID, take that as an example. Yes, there weren't that many cars on the street. That's for sure. How do you address that type of risk? It's really by looking at how predictable is it. It does happen. Toll roads, as an example, they will vary depending on the state of the economy. 100%. Pandemic was a very, let's call it interesting, I must say, in the investments that we have seen. At the end of the day, all worked out quite well. And why? It's because the structure that you also put in place. Like when it comes to toll roads, you expect they're going to be volatility. It's not always going up like that. Absolutely not. No, they're going to be, as you go, volatility in traffic demand, in pricing demand, in particular when you provide 10, 15, 20-year capital. So that's where our structure comes into place. So very often these structures benefit from financial covenants. where once the financial covenant shows a certain leverage level where you say, okay, distributions need to be stopped, need to be contained within the project to ensure there's enough capital to survive this period. When you look at situations like COVID, you, in addition to that protection, because when the financial covenant is triggered, looks great on paper, but if there are no cars driving, it's still an issue. And that's certainly something where in COVID you have seen across the globe. So that's where you very often benefit from cash reserves on top of that. So you benefit from debt service reserves, from maintenance reserve, or O&M reserves potentially. So it really depends on the underlying structure. But we do try to counteract these situations by, again, first level of due diligence, which is always a bottom-up approach. Is it cyclical? Is it not cyclical? Depending where it ranks, you got to put structure in place that makes sense. And don't get me wrong. If something, and that's what I mentioned with infra, is it not infra? If something is extremely cyclical and is correlation of 1 time to GDP, it might not be even infra, or not be infra considered in our world at least, right? So that's where you can come up with the best structure in the world, but if the infra element is still missing there, the criticality of it, it's certain that you can structure for that, I would say.
Yeah, I mean, it's absolutely right. What we have seen over the last few years is that regulation and political uncertainty have become a major shaping force in the infrastructure debt market. But not always in the same direction, right? In fact, they have created a mix of push and pull factors that investors are now more actively investing in the asset class as well. So what we have seen is that some countries have pushed infrastructure, have provided subsidies, are pushing these assets into a market to be competitive. So on the other hand, you're absolutely right. There's more and more volatility in the market, with some downside potential at least. This is driven by the regulatory perspective. We also were talking about ESG, but also from political uncertainty. And this is a major driver for sure in Europe. But what we are doing in infrastructure, we concentrate, as Valter said, on stable cash flows, which have to be independent of these cycles. And what we are always doing in our analysis, in our what's going in our investment decisions, we always look into political risk. We always look into regulatory risk. We make an assessment on that, and this is already part of the analysis, and it's going into the situation and how do we mitigate these risks. But I think the core of infrastructure debt is to concentrate on cash flows which are independent, which are not driven by politics, which are not driven by elections, which are not driven by the regulatory environment. However, and that's have to be kept in mind, looking back in some countries where there was a strong shift in the political direction, and in some cases, like in Spain, 13 years ago, where a lot of market players invested into the market and were backed by feed-in tariffs in the market, or sometimes also in motorways. And if in a country the regulatory environment will be changed and you are not able to work anymore on the market, I mean, this creates value. And that's what we have to keep in mind. Downside protection also includes the regulatory environment. But in general, looking back, and we just discussed the last 10 years, when we invested in infrastructure debt into contracted cash flows, we had contracted cash flows stable over time. So, and that's the core of infrastructure. The world around us is changing. Our cash flows are coming. And I think the beautiness of infrastructure debt is There's not a huge correlation with the GDP, which is different to other markets.
Fascinating, actually, to hear how, although the perspective is somewhat starts from a different place, actually the issues are very much shared across the different parts of the market. Let's perhaps just sort of move on the conversation now to the final sort of segment, which is really about where you see the opportunity going forward. And I'm interested to know how, whether or not your perspective on the hot market opportunities, either geographically or by sector, and how closely aligned to the equity play that is. I suspect it's very similar from what we've been saying so far, but let's get your thoughts on, where will you be looking, particularly looking for the next opportunities over the next couple of years or so, from a market and a sector point of view?
I can start. What we love to invest in is in situations where you have a strong demand and a undersupply to create additional premiums. That's where we feel comfortable. This can be driven by different reasons. One is the geographic allocation, where there's sometimes an undersupply. This can be driven or is driven by a lot of liquidity in some markets. So the senior market, which is also usually a bankable market, where you can find a lot of liquidity, is different to the holdco market, where you usually don't see your competitors in the same deals. So you create tailor-made situations usually with the sponsor to find solutions where you don't usually talk about the basis points in terms of pricing, because the added value is to get the additional leverage, to get a tailor-made situation structure. What is a key component to be able to do that? You're a bit closer to the equity position compared to the senior financing party, for sure. So you think you need more technical expertise. You're a bit more looking from the equity perspective. You're a bit more looking into the cash flows, cash trap mechanisms, that there's no distribution to the equity sponsor before you are a bit more de-risked. So the view is different. And having that said, on the other hand, there are a lot of similarities, as said at the beginning. Downside protection is key for us. But where do we see the most interesting parts of the market? Where we can find complexity, where we can find undersupply, where we can create additional, or where we can add alpha for our investors and earn additional premiums. That's where we feel most comfortable.
Yeah, John, you mentioned about what are the trends, what do we see, and one thing I always want to make clear is we don't chase the hottest trends because usually when it comes to the hottest trends, they're not really IG focused. So it might be a different type of capital stack that looks at these type of assets. But just to give you a sense, what we have seen or what we expect over the coming months and years. And one disclaimer, things change all the time, in particular over the last 5 years, how things have moved. But one element or one sector, of course, is the whole digital infrastructure that has been, 10 or 15 years ago, not really being considered as infra, maybe more real estate angle / infra or corporate. Now it really depends, and it depends on the criticality and the revenue stream that is going in there into these type of assets. But we have seen a significant push for, of course, for data center development in the North American market. In Europe, you see that. Depending where you see or what type of press release you see, it's trillions of dollars, euros that are expected to be spent over the coming years. So we do see a lot of development on that front. When it comes to data centers, the one element that cannot be forgotten is also access to energy in form of ensuring that power generation is available, but also connectivity. So we do expect to see significant investments in transmission assets, behind the meter power plants potentially as well. So that's certainly a sector that's going to evolve, and it's evolving more and more. And when you look at it historically, a lot of it has been financed in the banking market, in particular when it comes to greenfield development, and then once stabilized, a lot of it is being placed in the ABS or CMBS market. So we do believe that it's going to be a stronger push to see something in the investment grade space potentially as well. Again, the focus would probably be more like a hyperscale type approach, or making sure that underlying cash flows are stable, predictable. And apologies, you have heard that term many times over the last 30 minutes. The other element aside of digital, transportation is a constant. It's a segment that constantly pops up because when you look at focusing on Europe, when you look at the rolling stock market, for example, we're dealing with depending on the geography, depending on the country, there's quite old diesel type rolling stock available in the passenger side. Freight, well, naturally it's a bit more diesel focused, but again, the focus there is to procure new rolling stock, more efficient diesel trains, or even like battery or hydrogen. So we have seen a lot of demand in that segment as well. But again, things change. When COVID hit, certainly the digital element received a massive push back then. So it's very hard to predict what the next 12 or 24 months will get us. But again, the focus is on underwriting transactions that make sense from a borrower perspective, but also, of course, most importantly, from an investor perspective, because that's the expectation and that's the responsibility that we have for our investor base, to ensure that we underwrite assets that provide the stability in cash flow stream for our investor base at an IG level.
Yeah, Valter mentioned an important topic, and I fully agree on that. We see more and more combined assets in the market. Though in the past, as we've seen solar PV, wind, a motorway, a data center, but what is more and more coming into the market is a combination of these assets. For example, solar PV plus battery storage, for example. And why it's the case? Because the battery storage element adds additional value to the solar PV plant, to be independent or to mitigate potential negative pricings over the day, which is in the European market a topic, right? We are discussing. We see it in the digital market as well. Data centers in combination with energy production. We see it in the biogas, biomethane market at the moment. So what we are seeing is more and more combination of assets to create a higher value for the equity position, to add value, to stabilize the asset, which is important to us on the debt position. But that's an interesting part, and I think players who are able to invest in different sectors, who understand different sectors, who have invested, have track record in these sectors, are able to understand these more complex markets probably better than more focused players, which are mainly investing in renewables or just in digital. So I think that's a very important point, and probably already a trend for the next years.
Well, thank you both very much for that conversation and for helping to lift the lid a little bit on the world of infrastructure debt investment. I've really enjoyed listening to your articulation of the way that you set about that, the way you think about that challenge and the opportunities that are there. So thanks for joining us, and we look forward to seeing you in the near future.
Thank you, everyone. Thanks, John. Bye-bye.
So that's all for this episode of Talking Global Infrastructure. I'm Jon Phillips. Thank you very much to my guests. You can find out much more about the latest market-led reports and insights for 2026 on our website at giia.net. You can also follow us on LinkedIn and subscribe to our monthly newsletter for the latest industry news and updates on our famous events program. If you haven't yet, make sure you subscribe or follow us on Spotify, Apple Podcasts, or wherever you stream for more episodes like this one. And finally, if you've got an idea for an episode or feedback to share with the team,
give us a shout at communications@giia.net. We'll see you next time.